Imagine having the power to turn market uncertainty into a wealth-building opportunity. What if I told you that right now, during these turbulent times, you could make investment decisions that set you up for long-term success? Sounds intriguing, right? Well, today we're diving into two of the hottest dividend-focused ETFs, SCHD and JEPQ, to uncover which one could be your ticket to financial growth in 2025. These two ETFs are widely popular, but they couldn't be more different in their strategies. One prioritizes long-term growth and consistent dividend increases, while the other focuses on delivering a jaw-dropping monthly income. By the end of this video, you'll not only understand the pros and cons of each, but also have a clear picture of which one could align with your financial goals. Before we jump in, do me a quick favor, smash that like button and subscribe to the channel if you want more content like this. It helps the channel grow and ensures you never miss out on game-changing investment strategies. Alright, now let's dig into the details. We'll start by examining what makes SCHD a favorite among growth-focused investors. Then compare it to JEPQ's income-driven strategy. Stick around, because I'll also share some eye-opening data and my personal take on which ETF deserves a place in your portfolio. There's uncertainty in the financial markets. What's ahead for 2025? I like to remind people that turbulent times like the ones we're seeing as 2025 begins are when real fortunes are made. Think back to years like 2022 or 2010. How many times have you thought, I should have invested more in insert your missed opportunity? These moments are your chance. In this video, we'll explore two prominent dividend-centered ETFs, SCHD and JEPQ. Both deliver strong returns, but they take distinctly different approaches. By the end of this discussion, we'll figure out which could be the better choice, or if both deserve a place in your investment strategy. Now picture SCHD's performance last year. If Broadcom had once again been its leading holding, just think about the possibilities. SCHD is an ETF comprising of 100 stocks, reviewed annually and rebalanced every 3 months. But how does this compare to JEPQ? JEPQ, on the other hand, is much more centered on generating income. While SCHD blends equity and dividends, JEPQ tends to attract investors chasing that substantial attractive yield, which we'll examine more closely shortly. JEPQ is an actively managed ETF, meaning there's significant human oversight, resulting in higher management fees. The team frequently trades in and out of its underlying assets. Additionally, it employs a strategy of selling out-of-the-money call options on indices like QQQ or the Nasdaq 100. This latter part of the strategy is what produces JEPQ's impressive distribution yield. They earn dividends from the stocks they hold and collect option premiums from the calls they sell. These combined earnings are then distributed to shareholders. Using covered call strategies like selling out-of-the-money options is something I regularly implement. Since its debut in May 2022, JEPQ has outshined SCHD in terms of performance. Although the available data covers only a short period, JEPQ has gained 9%, while SCHD has grown just 4%. When we factor in total returns, the difference becomes even more pronounced, with JEPQ delivering nearly 50% compared to SCHD's 15%. However, I'm hesitant to base conclusions on limited data. That's all we currently have for JEPQ. On the other hand, SCHD boasts a much longer history. Over the past decade, SCHD has achieved a total return of 183%, translating to an impressive annual average of 18%. Before the recent surge driven by massive growth in tech giants over the past 2 years, SCHD had consistently outpaced the S&P 500 during the preceding decade. This kind of extended performance record carries much more weight in my evaluation. Both ETFs can be excellent choices, depending on an investor's priorities and strategy. It's also vital to grasp the method behind JEPQ and similar funds like JEPB, particularly their reliance on selling covered calls. Here's an example of a potential drawback. When you sell a covered call, you earn upfront income, but may be required to sell your shares if the stock's price exceeds the strike price of the option. That's why the distribution yield for JEPQ can fluctuate significantly when observed over the past couple of years. Now, shifting to SCHD, let's review its top 10 holdings. Pfizer, AbbVie, Cisco Systems, Coca-Cola, Texas Instruments, Bristol-Myers Squibb, BlackRock, Amgen, Chevron, and Verizon. Over the last few years, this lineup is probably one of my least preferred top 10 holdings from SCHD. Losing Broadcom in the portfolio last year was a significant drag. So to say I'm eagerly anticipating the rebalancing in March 2025 would be putting it lightly. When it comes to dividends, however, SCHD sets itself apart from other dividend-focused ETFs. It offers a higher yield than many high-yield ETFs and boasts faster dividend growth compared to most dividend growth ETFs. Currently, SCHD's yield is 3.7%, with a 5-year dividend growth rate of 12% and 13 consecutive years of increasing payouts. I have a strong preference for ETFs and stocks that consistently grow their dividends year after year. Comparing the two, JEPQ obviously has a far higher yield. So which of these options is the better choice? As always, the answer depends on the individual investor and their goals. There are two clear and simple reasons why I don't make JEPQ a permanent holding in my portfolio. First, it has limited potential for upside growth. Second, the approach it uses is something I already manage on my own with the stocks I hold. So why would I pay a 0.35% management fee for a strategy I'm already executing successfully myself? Now, when it comes to SCHD, it has an absolute secure long-term place in my portfolio, and there are 3 key reasons why I favour it. First, its technology exposure is minimal. Losing Broadcom wasn't ideal, but this reduced tech concentration makes SCHD an excellent addition alongside broader market funds like the S&P 500 or portfolios with significant tech positions. Second, it consistently provides a dependable growing dividend. Third, its strong dividend growth amplifies the effects of compounding, creating powerful momentum for long-term wealth building. But if I were forced to choose just one, and you might be asking me to, my choice would be SCHD. That's because I prioritize long-term investing above all else. Of course, every investor has different needs. For instance, retirees might gravitate towards JEPQ for its higher yield, as their main focus is income generation. However, since I'm still building wealth, I prefer a combination of share price growth and dividend increases to drive my portfolio forward. Let me know in the comments below which of these ETFs do you think is the better fit for your portfolio. Every investor's goals are unique, and what works for one might not suit another. Before we wrap up, let's take a moment to review some recent updates and key points about these 2 ETFs to provide even more context for your decision making. Recent performance and yield updates. As of January 2025, SCHD continues to attract long-term investors due to its steady performance and dividend reliability. Currently priced at $27.99 per share, SCHD offers a dividend yield of approximately 3.62%. providing consistent income with minimal volatility. On the other hand, JEPQ, trading at $52.27 per share, remains a favorite among income-focused investors, with its impressive 9.62% dividend yield, distributed monthly. This higher yield aligns with JEPQ's strategy of generating returns through options, premiums, and dividends. Cost efficiency. Another factor to consider is cost. SCHD, known for its low expense ratio of 0.06%, is one of the most cost-efficient dividend ETFs on the market. This makes it an excellent choice for long-term holders who want to maximize returns by minimizing fees. Meanwhile, JEPQ's expense ratio is higher at 0.35%, which reflects its actively managed nature. This fee accounts for the human oversight involved in its unique strategy of selling options on major indices like the Nasdaq 100. Recent developments in JEPQ. JP Morgan has been expanding JEPQ's reach by launching European versions of its equity income-focused ETFs, offering international investors access to the fund's strategy. This move highlights JEPQ's growing popularity and its appeal to those seeking consistent monthly income paired with growth potential. However, it's essential to consider whether this actively managed approach and higher costs align with your investment style. Why SCHD stands out. SCHD continues to be a cornerstone in my portfolio for several reasons. 1. Balanced exposure. Its limited tech exposure complements portfolios already weighted towards tech-heavy funds like the S&P 500. 2. Reliable dividends. It offers a stable growing dividend, currently yielding 3.7% with a 5-year dividend growth rate of 12%. 3. Compounding potential. With 13 consecutive years of dividend increases, SCHD leverages the power of compounding, making it a standout for long-term wealth building. JEPQ's role for income seekers. For those prioritizing immediate income, JEPQ's strategy is undeniably appealing. Its combination of options, premiums, and dividend payments allows it to provide a yield far above average. However, the capped upside and higher fees mean it may not suit all investors, particularly those focusing on share price growth and compounding. Final thought. So, which of these ETFs comes out on top? The answer depends entirely on your goals. For retirees or income-driven investors, JEPQ's high monthly yield could be a perfect fit. However, for long-term investors like me, SCHD's focus on growth, stability, and compounding makes it the better choice. Now it's your turn. Let me know in the comments which ETF you prefer and why. Whether you lean toward SCHD for its reliable growth or JEPQ for its income potential. Every investor's journey is unique. And if you enjoyed this video and want to see more ETF comparisons or detailed investment breakdowns, let me know below. Don't forget to like this video, subscribe to the channel, and I'll see you in the next one. Take care and happy investing. Your journey to financial freedom continues, and I'm excited to be a part of it. Here's to your investing success. Profitable investing.